Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at SLV, the iShares Silver Trust.
If you find our talks useful, please consider subscribe, like, and comment underneath.
You know, when we talk about silver, I feel like people have this very specific, maybe a slightly outdated image in their heads.
Right.
They're picturing, I don't know, antique cutlery, maybe a second-place metal. It's always been the runner-up, metal to gold.
Uh-huh.
But looking at the research for today, we really need to completely reset that mental image. Silver isn't just a shiny metal anymore. It has effectively morphed into a critical technology component.
It's basically a tech stock disguised as a rock.
That's a great way to put it.
And the market has certainly noticed that shift. I mean, looking at the data, we have to talk about the numbers right out of the gate because they are genuinely staggering.
Yeah, they are.
I was looking at the performance data for 2025, and SLV posted a return of 147.86%.
Which is absolutely massive.
It's enormous. We are not talking about a slow-moving commodity here or some safe haven that barely keeps up with inflation. This thing is outperforming major tech stocks.
And outperforming gold by a wide margin.
It is moving with a velocity that we rarely see in the metals market. It feels more like, I don't know, a biotech breakout than a commodities trade.
Exactly. And that brings us to the mission for today's talk. With the stock trading near historic highs, it's hovering right around $84.56.
Uh-huh.
We have to answer the big question. Is chasing this now just a case of fear of missing out? Good old FOMO? Or is this a legitimate entry point into, well, a multi-year supercycle?
Are we late to the party, or is the party just getting started? Okay, let's unpack this.
Yeah.
Before we get into the wild returns, I want to do a quick identity check.
Good idea.
Because SLV isn't a company in the traditional sense, right? If I buy a share, I'm not buying stock in a mine. I'm not betting on a management team.
Right, and that is a critical distinction to make early on. It's so important to clarify that SLV is not a mining company. You're not buying a business with a CEO, a marketing department, sales targets.
So no earnings calls where they try to spin a bad quarter.
Exactly. No corporate fluff. SLV is a trust. Its sole purpose is to hold physical silver bullion. It's just a vehicle designed for investors to get exposure to the spot price of silver.
Without the headache of, buying a safe and stacking heavy bars in your basement.
Yes, which is a logistical nightmare. The insurance alone, and silver is bulky.
So the revenue model, or lack thereof, is simple. The earnings are purely the appreciation of the metal in the vaults.
That's it. As of the latest data, the trust holds about $47 billion in assets, and this is key for any skeptics out there. It's backed one-to-one by physical silver.
That transparency is crucial. You know that the paper you hold is theoretically backed by metal in a vault. But let's get back to that growth engine. You said silver has morphed into a tech component. How do we get from a shiny metal to a 147% rally?
It's about shifting the narrative from precious metal to industrial necessity. The rally we saw in 2025 wasn't driven by people buying coins because they were scared of inflation.
Although that probably played a small part.
So a small part, sure. But the real driver is that photovoltaic demand is stripping supply.
Solar panels.
Solar panels, but specifically the evolution of solar panels. The green energy transition is incredibly silver intensive.
Because it's the most conductive metal on Earth, right?
Yeah.
Better than copper, better than gold.
Exactly. And here's the kicker. The industry is moving toward newer types of cells, like Toddy-Beacon and HAT cells.
These are the next-gen panels, the ones that are more efficient at converting sunlight.
Correct. And the trade-off for that higher efficiency is that they actually require more silver per panel than the older models we've used for the last decade.
So as the technology gets better, it gets hungrier for silver. That's a powerful driver.
It's a huge driver.
Yeah.
And it doesn't stop at solar. You have multiple sectors firing at once.
So what else is driving it?
Tech infrastructure. The rollout of 5G, the massive build-out of AI data centers, the semiconductor industry, they all require silver.
Right.
We're in a structural deficit where consumption is exceeding mining output. We literally cannot dig it out of the ground fast enough.
And you can't just spin up a new silver mine overnight.
It takes about 10 years on average.
Right. And that puts the performance into a new light. I mentioned the 147% return in 2025, but if you look back at 2024, the return was what, around 20%?
Which in a normal world is a respectable year.
It's a great year. But then 2025 hits and it just explodes. That acceleration is what catches my eye. It feels violent.
It is violent, but it suggests a repricing of the asset. The market is realizing this isn't just about speculation, it's about scarcity. Price has to go up to either incentivize new supply, which is slow, or to rationalize demand.
And for a solar panel manufacturer, Seaver is a tiny fraction of the cost, but totally essential. They have to buy it.
It's inelastic demand, which is the holy grail for an investor.
Okay, so let's pivot to the charts. The fundamental story is strong, but what are the technicals telling us right now? We're at about $84.56.
If you look at the technical ratings, specifically from ChartMill, SLV is rocking a 10 out of 10 technical rating.
A perfect score, that's rare.
It is. The stock is showing textbook breakout behavior. It's consistently setting higher highs and higher lows. Imagine a staircase going up. Every dip gets bought at a higher price than the last one.
That's the definition of a strong uptrend. The big money isn't selling into strength, they're adding on weakness.
Precisely.
However, I have to play the skeptic here for a second. I'm looking at the RSI, the Relative Strength Index, and it is currently sitting above 70.
It is.
For listeners who don't stare at charts all day, can you explain what that usually means?
Sure. The RSI is like a speedometer on a car. When it goes above 70, it enters what we call overbought territory. It means the engine is running hot.
Conventionally, that means the price has moved too far, too fast, and it might need to cool off. Does that worry you?
It's a valid concern. And in a normal market, I would say yes, be careful. But here's the counterpoint. In strong bull markets, what we call super cycles, assets can stay overbought for long periods.
So it can stay overbought for weeks while the price climbs another 20%.
Exactly. You don't want to stand in front of a freight train just because the speedometer says it's going fast.
Yeah.
And looking at the chart, support levels are establishing firmly around $80.
So long as we hold that level, the trend is up.
The trend is clearly up.
There's also this concept I saw in the notes called blue sky territory. What does that actually mean?
This is one of my favorite technical setups. Because SLV is nearing historic highs, there is very little overhead resistance.
Explain overhead resistance for us.
Okay, so imagine a stock hit $100 3 years ago, then crashed to 50. You have all these people who bought high and have been miserable for years.
They're bag holders.
Exactly. As soon as the price gets back to 100, what do?
They sell. They just want to break even and get their money back.
Right. That selling creates a lid on the price. But here, with SLV breaking into new highs, almost everyone who owns it is in profit. There is no one looking to get out at break-even.
That lack of selling pressure allows the price to drift higher much easier.
That's blue sky territory.
It's basically the absence of regret in the market. Okay, so strong fundamentals, strong technicals. What about the mood? Let's talk sentiment.
The narrative has shifted completely. A few years ago, silver was the boring trade, the poor man's gold. Now, headlines are calling SLV the hottest trade of 2026.
And the quantitative scores back that up. We're seeing overwhelmingly bullish coverage. But I want to look at what the big players are doing. Let's look at the options market.
Right, this is where we see what the smart money is actually doing.
And the data here is wild. Open interest is massive. We're talking 10 to 12 million contracts. That's more than double the 30-day average.
That volume tells us this isn't just retail investors. Institutions are piling in. This requires major capital.
And what's the direction? Are they betting for it or against it?
It's not hedging. It is pure aggression. Call options bets that the price will go up are dominating put options by a ratio of roughly 65 to 35%.
That's a very bullish skew. If they were worried about a crash, they'd be buying puts to protect their portfolios.
Instead, they're buying calls. They're leveraging up for more upside. And we're seeing some unusual activity from the whales, too. Massive block trades.
What kind of trades?
We've observed huge block trades of call options at strike prices of $62, $72, and even $75 for future expirations. These are deep in the money calls.
Okay, translate that. Why buy deep in the money calls instead of just buying the stock?
It's about leverage and efficiency. You're mimicking stock ownership, but with less capital up front. It means they aren't just day trading. They are positioning for a sustained move higher through 2026 and 2027.
That is a very strong signal. But we have to keep our feet on the ground. Let's dive into the bear case. What are the risks?
There are legitimate risks, and ignoring them is the fastest way to lose money. Risk number one is that overheating signal we talked about.
The RSI above 70.
Yes. Even in a bull market, nothing goes up in a straight line. A pullback to that $80 support level is statistically likely.
So if you buy today, you need to be mentally prepared to see some red on your screen temporarily. You can't panic if it drops $5.
You need the stomach for it. Then there's the warning from Goldman Sachs about extreme volatility.
What are they worried about?
They're pointing to tight physical supply in London and new export controls from China.
Wait, if China restricts supply, shouldn't that make prices go up? Why is that a risk?
Long term, yes. But in the short term, it creates chaos. If metal can't get where it needs to be, you get violent price swings. Goldman is basically saying expect a bumpy ride.
Got it. So volatility is the price of admission. What about issues with the trust itself? Does it cost money to run?
You have to mention the fees. SLV charges a 0.50% sponsor fee annually.
0.5%?
It doesn't sound like much, but over a long hold, it erodes the amount of silver represented by each share. The management takes a tiny sliver every year.
It's the cost of convenience.
Correct. It's not a deal breaker, but it's a drag on performance. And finally, you have macro factors.
The Federal Reserve?
The Fed is the invisible hand here.
Yeah.
If interest rates spike unexpectedly, non-yielding assets like silver usually suffer.
Because silver doesn't pay a dividend. If I can get 5% risk-free in a government bond, why hold a metal rock?
That's the traditional logic.
Yeah.
Now, I think the industrial demand argument acts as a buffer against this, but a hawkish Fed would certainly be a headwind.
Okay, we've laid out the massive growth, the technicals, the institutional betting, and the risks. Time for the verdict? What's the score?
Putting it all together, the industrial shortage, the breakout pattern, the sentiment, I'm assigning a bullish score of 9 out of 10.
9 out of 10. That is high conviction.
It is. SLV is no longer just a hedge against inflation. It is a play on the physical shortage of a critical technology metal for solar, AI, EVs.
Yeah.
The 2025 run was the wake-up call.
And the options market says the big money thinks it's just the start.
Exactly. The institutions are betting this run isn't over.
So what's the elevator pitch? What's the strategy?
The pitch is this: a historic breakout in a scarce asset, essential for the future. But don't chase the green candles blindly.
Acknowledging that overbought signal.
Right. The smart play is to look for entries. If we get a dip near that $80 support level, that is your buy zone.
Buy the dip, don't chase the rip.
Precisely. And in terms of horizon, this is not a trade for next week. It's a multi-year hold, targeting the $100 to $120 range as the supply squeeze tightens.
That is a significant upside from here. We're talking another 20 to 40% potentially.
It is. But remember, volatility is the price you pay. If you can handle the swings, the structural fundamentals are the strongest they have been in decades.
It really feels like a perfect storm. Industrial demand providing the floor, speculative interest providing the ceiling.
And one final thought, the gold to silver ratio. How many ounces of silver it takes to buy an ounce of gold is historically high. Silver is cheap compared to gold.
So it's a catch-up trade as well.
It's a catch-up trade and a growth trade all in one. If it just reverts to its historical average, the math gets really exciting, well beyond $120.
A fascinating perspective. Well, there you have it. Silver isn't just shiny, it's essential. A reminder that while silver is shiny, the industrial utility is what pays the bills in this portfolio.
Absolutely.
If you find our talks useful, please consider subscribe, like, and comment underneath if you enjoyed the analysis. We'll see you in the next one.